The mass index indicator is calculated through a precise mathematical formula. At its core, the mass index formula identifies changes in volatility by tracking the relationship between trading ranges and their moving averages. The mass index calculation involves four distinct steps. First, calculate the 9-day exponential moving average of the high-low range for each price bar. Second, calculate another 9-day exponential moving average of the result from step 1. Third, divide the first EMA by the second EMA to get a ratio. Finally, sum this ratio over a 25-day period to obtain the mass index value. Let's visualize how the mass index formula works with price data. Here we see the daily high-low price ranges represented as vertical bars. The first step calculates the 9-day exponential moving average of these high-low ranges. After calculating a second EMA and finding their ratio, we sum this ratio over 25 days to get the mass index value. The mass index rises when the difference between the two EMAs increases, which typically happens during periods of changing volatility. The primary signal in mass index analysis is known as the reversal bulge. This signal occurs when the mass index indicator rises above 27 and then drops below 26.5. When this pattern appears, it suggests that a potential price reversal is imminent. It's important to note that the mass index itself doesn't predict whether the reversal will be bullish or bearish. Traders must use other technical tools to determine the direction of the potential reversal. The mass index simply alerts traders to an increased probability of a directional change in the market, serving as an early warning system for potential trend reversals. Let's compare the mass index to other popular volatility indicators. Unlike the VIX or Bollinger Bands, which directly measure volatility, the mass index has a different approach. The VIX measures market-wide volatility across all stocks. Bollinger Bands measure deviation from a moving average, showing when prices are relatively high or low. Average True Range, or ATR, measures the absolute value of volatility, focusing on price movement magnitude. In contrast, the mass index examines the pattern of volatility changes rather than just the absolute values. This focus on pattern recognition makes the mass index fundamentally different from other volatility indicators. The mass index specifically examines how the range between high and low prices changes over time, rather than just measuring their absolute values. This makes the mass index complementary to other indicators rather than redundant. It can identify potential reversals that might be missed by trend-following indicators. This is especially valuable in markets that exhibit changing volatility characteristics, where traditional indicators may struggle to provide timely signals. Most major trading platforms include the mass index indicator in their technical analysis tools. Let's look at the most popular platforms where you can easily access and set up the mass index indicator. The general process for adding mass index to your charts follows these four simple steps. The default settings are typically a 9-period EMA for range calculations and a 25-period summation window with a 9-period signal line. Let's walk through the process of adding mass index on TradingView, one of the most popular platforms. First, click on the Indicators button in the top toolbar. Then search for Mass Index in the search box. After finding Mass Index, click on it to add to your chart. A settings panel will appear where you can adjust the parameters. These parameters can be adjusted based on the time frame being analyzed and your specific strategy requirements. Consider your trading style when adjusting mass index parameters. Different strategies may require different sensitivity levels. By properly setting up and customizing the mass index indicator for your specific needs, you'll be able to more effectively identify potential market reversals and volatility shifts. The mass index indicator is a powerful tool for identifying potential reversals, but on its own, it doesn't indicate market direction. To enhance its effectiveness, traders combine the mass index with various trend identification tools. These include moving averages, trend lines, and price action analysis. Each provides context for the potential reversals identified by the mass index. Let's see how this combination approach works with a practical example. Here we have a price chart showing a downtrend that's testing a major support level. Below, we see the mass index indicator forming a reversal bulge just as price touches the support level. This combination of a mass index reversal bulge occurring precisely at a major support level provides a stronger signal than either indicator alone. Let's examine why this combination approach is so valuable. Here are the key benefits of combining mass index with trend analysis tools. First, trend analysis helps filter out false signals from the mass index, reducing the likelihood of entering trades prematurely. Second, trend tools add directional bias to reversal predictions, helping determine whether a reversal will be upward or downward. Third, this approach helps identify higher probability trading opportunities by confirming signals across multiple methods. Fourth, the combination provides precise timing for entries and exits, enhancing trade execution. Finally, the overall predictive value of the mass index is significantly improved through this multifaceted approach. By combining the mass index with trend analysis tools, traders can create a more robust trading approach that leverages the strengths of multiple technical methods. The mass index indicator performs differently across various market conditions. In trending markets, the mass index helps identify potential exhaustion points where trends might reverse. In ranging or consolidation markets, it can signal potential breakouts when volatility begins to expand. The indicator is particularly useful in markets that alternate between periods of low and high volatility. The mass index works especially well in certain commodity markets, cyclical stocks, and some forex pairs that exhibit these volatility patterns. Traders should be aware that the effectiveness of the mass index varies depending on the underlying market dynamics. The mass index can be applied to various timeframes, from intraday charts to weekly analysis. Let's explore how the effectiveness of mass index varies across different timeframes. On shorter timeframes like intraday charts, the mass index generates more frequent signals, shown by the teal line. However, signal reliability, shown by the gold line, tends to be lower on these shorter timeframes. Let's examine the specific characteristics of different timeframes. Intraday timeframes offer many trading opportunities, but come with a higher risk of false signals. Daily charts provide a good balance between signal frequency and reliability, making them popular among many traders. Weekly charts generate fewer but potentially more significant signals, suitable for longer-term position traders. When selecting the appropriate time frame for mass index analysis, consider these important factors. First, match the time frame with your trading horizon. Short-term traders should focus on intraday to daily charts. Consider market volatility. In highly volatile markets, longer timeframes may filter out noise better. Test your mass index settings on historical data across multiple timeframes to find optimal performance. Many professional traders combine multiple timeframes, using longer periods for trend direction and shorter ones for entry timing. Remember, there's no one-size-fits-all time frame for the mass index. The optimal setting depends on your specific trading strategy and objectives. By carefully considering these time frame factors, you can optimize your mass index implementation for better trading results. The mass index indicator can be powerful when incorporated into a structured trading approach. Let's examine a practical four-step strategy. Step 1. Identify a reversal bulge in the mass index indicator. This occurs when the indicator rises above 27 and then subsequently falls below 26.5. Step 2. Determine the likely reversal direction using technical analysis. Pay attention to price action, support, and resistance levels, or existing trend lines. In this example, price reached resistance and began showing weakness after a strong uptrend. Step 3. Wait for confirmation before entering a trade. Don't act solely on the mass index signal. Look for a price breakout in the expected direction, such as breaking through this support level. Confirmation may also come from candlestick patterns or other technical indicators. Step 4. Once you have confirmation, place your trade with a well-defined stop loss. For this short position, the stop loss is placed above a recent swing high. Target a reward-to-risk ratio of at least 2 to 1, and consider using trailing stops as the trade moves in your favor to maximize potential profits while protecting gains. To summarize this mass index trading strategy, first, identify the reversal bulge when the indicator rises above 27 and then falls below 26.5. Second, determine the likely direction using technical analysis. Third, wait for confirmation before entering the trade. Finally, place your trade with a logical stop loss based on recent price structure. This methodical approach helps traders capitalize on the mass index's ability to identify potential high-probability reversal points in the market.